chat about the actual stats, and we'll take questions anytime from the audience. And then when we're done with the presentation, we'll each of the panelists will talk as little or as much as they want about themes that they see out, or which slides in the presentation they like best. Tough crowd. So with how many of you have been to a MoneyTree presentation before? Okay, so you've seen this, some version of this slide. This tracks the venture capital over the last handful of years by quarter. And you can see things were kind of up and to the right from 05 through 08, and not surprisingly, things got a lot worse in 08 with the crash. And then they've kind of generally come back, although they've been very inconsistent. And one of the themes that you'll see later in the presentation, it's a little surprising that the venture investing has stayed so high, because the returns have been bad for 10 years, fundraising has been bad for 3 or 4 years. So in a normal market, you would expect funding to go down. In fact, I'll give you the answer first. Fundraising in the venture business is around $15 billion a year for the past 3 or 4 years. And even in the magical, mystical world of venture capital, they can only invest what they raise. And so you'd think eventually investing levels would come down to 15 billion, but they have not at all. So we're kind of in a period of disequilibrium right now. It cannot stay like this. Either investing has to come down, fundraising has to go up. To give you a little more historical perspective, this shows venture capital investing. This is all U.S. numbers in the last 30 or so years. How many of you were working somewhere in technology in the U.S. in the early 80s? And those of you that are working, how many of you thought there was a viable, vibrant venture business in the U.S. in the early 80s? You look at this and you'd think it was a little tiny cottage industry that did a couple deals. I mean, it was literally $1 billion, $2 billion, $3 billion a year for many, many, many years in the U.S. And so it kind of puts in perspective the numbers that we're looking at now, because now there's a lot of consternation, a lot of press when the venture business goes from, say, 30 billion to 20 billion or 25 billion to 15 billion, like the sky is falling. And yet, until 1997, we never had a venture year above 15 billion. So the scale of the venture business has really changed the last 15 or so years. And this gives you an idea why we're having this meeting in Silicon Valley, because it's been the dominant place for venture investing for quite some time. And ironically, the venture business started in Boston, so they essentially had 100% market share for 5 or 10 years. But Silicon Valley took over about 30 years ago. It's about a 50-year-old industry. And you can see it's pretty dominant. In fact, the 46, the 47%, these are the highest numbers Silicon Valley has ever had, which is a little surprising. You see, there's kind of 4 big areas. Silicon Valley gets about 40%, and then New York, Boston, and Southern California collectively each get about 10%. So about 70% of the market is in 4 cities in the U.S. A couple of quick stats on Silicon Valley. This just shows you all the money going in by quarter. This is all deals. Dollar value. So you can see it's 2 to 2.5 billion a quarter going into Silicon Valley. A lot of money going into deals in the valley. And that represents between 200 and 300 deals each and every quarter. Some of you might think, well, what about Series A? Hasn't that kind of collapsed? And it's certainly gone down, but you still see substantial amount of Series A money going in just in Silicon Valley, roughly 2 to 300 million. Quarter in, quarter out. We had a big surge in Q2 of this year, but it's generally in the 2 to 300 million range, and it's 50 to 100 deals of Series A each quarter in Silicon Valley. A couple charts just to show you funding by round. I'm not even sure what this signifies, but it's just so unusual or unexpected that we highlight it. I mean, I think everyone's familiar with rounds of funding, and you'd expect a lot of money in Series A and B and C and D, etc. But you see, there's still substantial funding in Series H and I and J and even K, L, M, N, O. How many people have been involved in a Series O deal? Like I keep asking, you can never find anyone that admits it. So somebody did it. But But I think one of the messages is just a lot of money flowing around the U.S. and specifically around Silicon Valley. So I think before you saw this chart, I think probably no one would have thought there's ever a Series O deal. But you'll see there's MRO like every quarter. If we went back and figured it, every quarter there's funding in later rounds. So which is a little bit mystical because we spend a lot of our time trying to help people raise money, and it's still really hard. I mean, funding is hard. It's always hard. And yet, if you meet the right metrics, there's a lot of money available even for very late-stage companies. We'll just quickly talk about some of the top deals in Silicon Valley over the past couple quarters. A lot of these names will be familiar, so I'll fly through them. But they're partly noteworthy because you can just see a lot of money going into these deals. And keep in mind that the median exit for a venture-backed deal, or M&A, is around $80 million. And so, these companies are raising, half of that or more in just one round. So this is a little bit like Garrison Keillor's old joke about, parents always think their kids are above average. And the same thing here. I mean, everyone thinks their deal is going to be the billion-dollar Instagram. But, collectively, there's probably going to be a lot of disappointment here because, probably not all these deals are going to go above, way above 80 million. And if you're raising 40 million in one round, you've got to sell for a lot more than 80 million for it to be considered a good deal. Same thing, Q4, you're going to see very, very similar results. Q1 this year, same thing. Q2, same thing. So, every quarter there's, several $100+ million deals, and even the bottom of the list is, 40, 50 million. Although some of them, like Instagram, do turn out pretty well. Investment by industry, you can see there's a little bit of volatility. No big stories here. Software has been the #1 category in the MoneyTree pretty much the entire 15 years we've been doing this. Industrial/energy is really a pseudonym for clean tech. And you see it's kind of stabilized at 10 to 15% of the total. Same thing with medical devices. Biotech's been a little more volatile, but in that order of magnitude. And same thing with media and entertainment. Well, this is starting to prove kind of the Andreessen claim that software is eating the world, because software and media and entertainment are really software/internet deals. So you can see 40, almost 50% of the deals now are having a pretty heavy software component. But we'll just look at the funding kind of, this is subjectively by the stage of the company. As you would expect, there's not much startup or seed money coming from VCs. But otherwise, a lot of money in all the categories and a lot in later stage and expansion rounds. If you look at the same funding by round of funding, you're going to see big levels in all, but the biggest chunk of money is going to fifth round and beyond. And this is one of the several reasons why the returns in the venture industry have not been very good by historical standards the last 10 years, because it is taking a long time to get exits. And one of the measures of venture is IRR, internal rate of return, and you kind of have to do two things. You got to make a lot of money, and you got to make it relatively fast to have a good IRR. Well, if your typical deal is raising 5 rounds or beyond, even if you make a lot of money, you're not making it very fast. So you probably will not have a good IRR. Series A, first sequence this is nationally. You can just see there's whatever that is, 200 to 300 deals each quarter. Still a lot of funding, and that represents about $1 billion a quarter of Series A deals, and they're about 15% of the market. If you're lucky enough to raise money, the bottom line here is $3 million is the median level of funding, which probably the more relevant chart, because the higher line is the arithmetic mean, and that kind of gets distorted by the big deals. So you can see it's 3 to 4 million for quite some time. We looked at the top deals in Silicon Valley, and this looks in the whole U.S. and even an exaggerated from what we saw before. Just a tremendous amount of money going into these deals. One difference is you'll see more of these companies based in Silicon Valley. I think what's this? 5 in the top 10. 5, 10 years ago, this was not so common. Silicon Valley was a little more, I'd say, disciplined about going into the big deals, where now you see a lot of the top deals in Silicon Valley. In Q2, it was 7 of the top 10 deals. This just shows you the most active investors in the U.S. A lot of household names here. Shows you where they're headquartered, but almost all these companies would do deals either in Silicon Valley or have offices in Silicon Valley, but very active. This is just Q2 of this year, so in a 12-week quarter, pretty much everyone's doing a deal a week, and some people are doing 2 deals a week. So particularly in the biggest top funds, a lot of activity. To summarize very briefly, M&A is still vibrant, a lot of M&A. The M&A IPO ratio has just completely flipped in the last 10 years. 10 years ago, there was probably something like 300 IPOs and about 100 M&A, and now it's really reversed. You can see there's 300 to 400 M&A events per year and 50 to 100 IPOs. So a complete swapping of the ratio. And as long as the IPO number stays relatively low, at least by historical standards, there's a lot of pressure on the pricing for M&A deals because not many companies have a viable threat to go public. So, without that, unless you can get more than one firm really interested in you at the same time, it's really hard to create maximum value. I alluded to venture capital fundraising issues before. You can see back in 2008, the venture firms themselves raised about $25 billion, and then 16, then 13, then 19. And this year it looks like they're actually on track for closer to 20. So we haven't seen the last 2 quarters, but if so, that'd be a blip up and indicate a little healthier environment, although you still hear a lot of horror stories about venture funds on the road trying to raise money. And the venture industry is really becoming bifurcated. The last few quarters, the top 5 funds each quarter have raised roughly 80% of the funds, and everyone else kind of shares the rest. So you have a handful of funds raising 200, 300, 400 million, and then you got a whole bunch of funds raising 20 million, 30 million, 40 million. So big division between the haves and have-nots. So there's a lot of good news and some not so good news. We've talked about a number of this, so I'll just summarize stuff we haven't. The big picture, if you think of the venture world, a third of it gets invested just in California. Another third is the rest of the U.S., and another third is the rest of the world. So, just a huge concentration right here in California. Also, advertising is just really beginning to migrate to the internet and especially mobile. Mobile's really in the news, especially with Facebook and a lot of companies trying to dominate mobile advertising in particular. And this gives you a sense of how much room there is to grow. The first line there, the percentage of time, that's our percentage of our media time we spend. So 8% of our media time is in print, 16% in radio, etc. And the second line is how much of the media dollars go there. In a perfect equilibrium world, those rows would be the same. So you can see, does anyone own a print publication here? Because if so, you should sell very soon. Because print publications are in deep trouble, because guess what? They're getting 27% of the media dollars, but only 8% of our time. And over time, those numbers will become the same. I don't think the 8% is going to go up, so I'm pretty confident that 27% is going to go down. And you can see where it's going. TV is kind of in equilibrium, but the internet's going to get a lot more money, and mobile's going to get a lot more money. So that helps understand why there's so much money pouring into internet deals, into mobile deals that would appear, at least on the surface, not to have a great revenue model. Because the money is coming. It's a question of how fast it'll come and how big it'll be and how widely it'll get dispersed. But there is a lot of media money coming into the internet and into mobile. But there's plenty of bad news too. We've chatted about the IPO market. The median venture return in the last 10 years has actually been negative. Your typical venture firm, you give them 100 million, they actually give you less back. The European debt crisis, the gift that keeps on giving, it seems to never end. Washington, D.C. has edged out San Jose for the wealthiest U.S. metro area, if you want a metaphor for what's wrong with America. Patent litigation is going up, settlements are way up. CalPERS, one of the leading all-time funders of the venture industry, recently publicly announced their venture allocation is going to go from 7% of their funds to 1%. That's a big drop. Stanford, Harvard, Yale, Princeton are all big contributors to the venture industry, and most, if not all, have announced they're going to reduce their allocation to the venture industry. These are the leading investors in the venture industry. So if the leaders are all cutting their investments, you can imagine what the followers are going to be doing. Life sciences is in particular trouble. A lot of funds have either announced they're reducing their investment in life science, or they're getting out of the business entirely until the FDA becomes, quote, fixed. So a couple just comments or predictions of what's going on in the venture market. Some of this we talked about, so I'll just tap on a few. The venture industry has had great public policy behind them. And one of the stats that's helped them, you can see, they've created a lot of jobs over the last 50 years. Of course, jobs are paramount now, but 92% of the job creation in venture companies happened after the IPO. So guess what? In a world where you only have 70 IPOs, you're not going to create quite as many jobs as when you have a world of 250 IPOs. So as that becomes more apparent, as there's fewer jobs created by venture-backed companies while they are venture-backed independent companies, that's going to reduce their clout in Washington, D.C. As a job creation vehicle. A prominent VC recently did a study, probably too strong a word, but claimed that 15 companies produced 97% of the venture profits in most years. So let's assume it's not statistically significant and it's exaggerated. But even if it's 30 companies create 90% of the profits. I mean, it begs the question, how many VCs do you need to find the 30 great companies in America every year? Right now the answer is about 3,000. Feels high. And so it gives you a sense of why there's been a compression of industry, and probably why 50% of the GPs that are in the industry now will probably be gone in 5 or 10 years. Globalization is a theme that's been going on for quite some time. We mainly talk about India and China, and so you'll see a lot of stats here. I'll just focus on a couple. China's been the number one economy in 15 of the last 18 centuries. So just because they've had a couple bad centuries, you don't want to rule them out. They're kind of used to being number one, and they're headed back that way pretty soon. Having said that, a lot of the reasons we talk so much about China is they've got the largest domestic population. Eventually, presumably, we'll have the largest domestic economy. But India is going to have more people than China probably in the next 10 years. And so when that's true, then that kind of ratio of how much we talk about India to China, I suspect, will really change. That's a quick summary of the actual stats. I'm going to introduce each of the panelists, and they're going to chat as little or as much as they want about themes they see. And again, we take questions anytime. With that, Vish, you've got the floor.
Oh, I got the floor. So anyway, just briefly, Vish Mishra. I'm a partner at Bengston Venture Partners. Our fund is, we basically invest in seed to early Series A. So I'm part of your $1 billion that you talked about, Series A to seed investments. So Bengston is a young fund. I've been in the firm for 11 years. So I'm a rookie in the venture capital business, but I'm really an operating guy. A lot of experience, in building companies and running companies. So again, Gerard will be here. Steve and I, we go back here, quite a while. What we invest in, again, is seed to early and primarily all in tech. So which is the consumer internet, a lot of stuff in the mobile, a lot of stuff in the cloud and the software. So we're not into life sciences, we're not into energy. So if there's any question on that, I'm probably the wrong person to address that one. We invest basically 80% of our funds are invested in the US, basically in Southern California and Northern California, split equally 40 and 20%. And we also have 20% of our investments are in India. We chose about 5-6 years ago to go to India. We figured that maybe that's the market that we need to be participating in. And so again, delighted to be here. Some of the notable companies that we funded, PayPal was our first institutional investor, and they did a pretty good job. We had eToys, we had Overture, that sold to Yahoo, and things like that. Some of the companies that in the current portfolio are doing very well in the advertising space, a company called the Rubicon Project. Then in the advertising space, I think month of July, they surpassed the traffic. They surpassed Google in traffic. They had like 200 12 and 12 million people came to see them, and Google had 206, so some press people said, gee, no, another headache for Larry Page, so I'm not too sure that we like that description. But anyway, so we got good company, we got a gaming company in India that doing amazingly good job. They started catering to Indian market, but all of a sudden it became a global company because youth everywhere, I think, have the same desire, same interest, and they play a lot of good games. A game called Parking Frenzy, I think they launched 2 months ago, and that both for iOS as well as Android platform, I think they had more people visiting and playing the game than Angry Birds. And this is pretty, everybody can relate to how you park and not park well, and I think that's what these guys capitalize on. Anyway, so we got a lot of good stuff. 6 people in the firm, and again, C too early stage. So that's how it is. So this is why.
Thanks, Vish. And next up is Guru with Lightspeed.
Hey, thanks Steve for having me here, especially representing Lightspeed. So let me give you a little bit of a background about both myself as well as our fund. I started my career many moons ago as a software engineer. Graduated from Purdue. I suspect not too many Boilermakers in the audience here. Mostly there aren't. We train up Midwestern engineers moving to the coasts for some reason. But anyway, after that, I ended up in the networking industry. As with most people in the networking industry, you have to go to Cisco and work there for at least a little bit of time. So I was very fortunate to work there on a very exciting platform. When that platform came to market, that was one of the fastest growing platforms to $1 billion. So keep count of that. This is how lucky people can get in their career. So that was the first one that got to $1 billion. Got hired after that, tried my hand at startups, was trying to raise money at a really bad time. I think it was about 2003, 2004. That was a bad idea. Ran into some really passionate founders at a company called Tropos Networks. They wanted to go in and just change the world. And if you ever go down, a couple of miles down Mountain View and you see this Google Wi-Fi pervasive mesh network, that was one of the first installations for Tropos' administrative networks, which was pretty exciting. But the market wasn't quite ready to take that up in a big way. So went on from there to entrepreneurs that vision was really well. Very passionate, very execution-focused engineering team who built some really interesting technology in networking space and in servers. That company got picked up by Cisco in the about, I think, 2008, 2009 timeframe, and resulted in 2 independent product lines for Cisco, both in the networking space and in the server space hit $1 billion run rates. So 3 platforms in my career that have hit $1 billion run rates, and that's just tremendously satisfying to work on something that's sort of a glint in an engineer's eye, and then eventually becomes a tremendously successful platform. And through this course, I've gotten to know some of the folks at Lightspeed pretty well. Late last year and early this year, they raised their latest fund. That was, unlike a lot of people that Steve you alluded to. We were very fortunate. Lightspeed team didn't have too much trouble raising that fund, and once the fund was in place, as I was talking to them, they said, we're going to be investing in the enterprise IT space pretty aggressively. We want to come on board and help us, find the next generation of entrepreneurs and help create some additional disruption. So earlier this year, I joined a team full time, helping out with enterprise IT infrastructure investments. That's what I do. A little bit about Lightspeed. We are, when Steve was alluding to, those top few funds that tend to take up 80% of the dollars every quarter. Those top 5 funds, he was talking about us as part of that group. So Lightspeed raised a $675 million fund, which is its 9th fund, and that announcement, I believe, came out in Q2, so I think we should be somewhere in those statistics. Lightspeed it's a global company. We've got offices here in the US, Israel, and that office handles a lot of European investments as well. We've got a full-time team of, I think, 4 investment professionals in India. And then we've got a whole team in China as well, and they raised their own fund, so that's sort of an affiliate more so than a full-time part of Lightspeed. So we're a global fund. Total funds under management, depending on what point you take a snapshot, is somewhere between $2 to $3 billion. We are primarily focused on 3 sort of key areas. Enterprise IT is where the majority of our focus goes, enterprise infrastructure, everything up and down the stack. So think hardware, think software, and certainly all the way to the presentation layer from an enterprise perspective. And then we focus also on consumer internet, digital media, to pick a few names, Tatum, for instance, comes to mind, and certainly a number of current investments as well. And then finally, we take a very opportunistic, tactical approach towards clean tech every once in a while. If we see something that's really, really interesting, really game-changing, then we'll go ahead and invest in that. And I think an example that you might have heard of is Nest. And that's a great example of a company that's sort of at the right intersection of really interesting technology applied to solving what would traditionally be energy management or clean tech issues. So that's been one of our really interesting investments so far. So that's a little bit about Lightspeed, and I'm sure we'll get to know a little bit more as we progress.
Thanks. And next up is Shaheen with Lux Capital.
Hello, I'm Shaheen. I'm with Lux. We're a venture capital firm. We build and invest in companies that are leveraging breakthroughs in the basic sciences that relate to energy, healthcare, and IT. We cut checks anywhere from $500,000 to help get a company off the ground, where we help put together the team, license the technology, get the company off to a quick start, and help lead the Series A round. We set aside up to $15 million per company for it to get to where we'd like it to go from a liquidity standpoint. And take very active roles. Of course, we lead, we take board seats, and we help companies get to their shiny and happy goals. So my personal background, I first started in the enterprise software space, writing applications for hospitals. I got tired of writing software, went on the hardware side, double majored at Berkeley, then went to GM for a short period of time. Wasn't crazy about Detroit, wasn't crazy about working in the automotive industry, although I am a car enthusiast. Realized that loving cars and working for the car business are two very different things. Came back to California, went to graduate school, started my PhD in electrical engineering. During that time, I started a company with my advisor, doing wireless vital sign monitoring, raised some money from the NSF, got a pilot going to UCLA. Then did a postdoc. During the course of my postdoc, got to know Lux and joined Lux in 2006. Lux has been around since 2000. We're now investing from our third fund, which we recently closed, a $200 million fund. We closed that fund in December of last year. We've so far made 6 investments from that fund. We do everything from therapeutics, diagnostics. We look in that space. We look in healthcare IT. We do a lot in energy. I personally have done 2 semiconductor investments. I'm also helping with our energy portfolio. Just to give you a sense of what we do at Lux is a kind of a 3-pronged approach to investing. We invest in great people, serial entrepreneurs. We invest in contrarian themes or theses. And we also invest in special situations. I can give you a quick example for all 3. On the people-driven investment side, there was a professor at UC Santa Barbara, Umesh Mishra, who started a company called Nitrous that was doing GaN on silicon. That was acquired by Cree for $250 million, and that became the basis of Cree's high-brightness LED business. He came to us in 2006 and said, hey, I want to start a new company. I don't know what I'm going to do. We said, say no more. We'll seed your new company until you figure it out. That company became transformed. We brought in Kleiner Perkins, Google Ventures, Foundation Capital, most recently Soros, and another round is actually coming together with a very big Asian strategic potential acquirer, in fact, as well. And they're making high electron mobility transistors for switch-mode power supplies and diodes that go into motor drives, EVs for industrial applications, solar inverters. So we're very excited about that one. So that's an example of a people-driven investment, a serial entrepreneur, which formed the basis of the company. The other is thesis-driven. So at a time when a lot of VCs here in the Valley were throwing money in solar and biofuels and wind, we took a step back and kind of thought to ourselves, what's an area that people aren't looking at as much? And we figured that it didn't take long to realize that nuclear is the basis for a lot of our baseline energy consumption. So we looked at the nuclear space and we realized that if we decide to build more nuclear, there will be more waste. If we decide to cut down on nuclear, there will be decommissioning, hence waste. And if we stay at the status quo, there's going to be still plenty of waste. So we set out to identify leading technologies and leading people within the nuclear industry. And we formed a company called Curion back in 2008 timeframe. Built a team. We didn't bring in your more, traditional Silicon Valley entrepreneur, younger Stanford grad. This was a silver-haired veteran, 30-year veteran of the nuclear business, John Raymond. who actually sold the company to Energy Solutions for $500 million. This person ended up becoming the CEO of this company. 6 months later, Fukushima hits. He gets a letter from TEPCO, which was running the Fukushima cleanup effort or disaster recovery effort, and said, "Hey, we've heard about you guys and your technologies. Come down to Fukushima and let's see if you can help us." So he packs for 10 days, comes back 5 weeks later with a $100 million contract to basically work with Hitachi, Areva, and Toshiba to basically clean up or decontaminate the water that had flooded the reactors in Fukushima. So basically, the company went from an unknown Irvine-based startup company to one of the most profitable venture-backed clean tech companies in history. So that's an example of one of our thesis-driven investments. On the special situations side, given 2007, 2008 timeframe, where a lot of semiconductor companies were having challenges, we became aware of an opportunity at a Freescale to carve out their magneto-resistant random access memory effort, or MRAM technology, which is a non-volatile memory technology that has a speed that potentially can have the speed of DRAM while being non-volatile. So it turns out that our venture partner, was running Motorola Labs at the time when this effort was started at Motorola back in the mid-90s. He actually built the initial team. That work was inherited by Freescale, and when Freescale was taken private, the private equity owners of Freescale wanted to spin out all non-core efforts, non-profit generating efforts, and this non-volatile memory effort was one of them. We basically carved this effort out of Freescale for nickels on the dollar. So we were able to acquire a revenue-generating company at a run rate of in millions at a Series A price, essentially. And now they've ramped up 10x since then. This is back in 2008, and they're one of the more exciting companies in our portfolio. So the special situations, people, and contrarian themes or thesis-driven investments.
So I'll start asking questions until I see questions from the audience. Well, first one, let's just chat about how the venture industry is changing with all the money that's around. It seems like there's a new incubator every week. Angels are everywhere. Even the corporates are claiming they're back in the business. The hedge funds are starting to play. And the venture industry, even though it's shrinking, is still huge. So it seems like there's plenty of money, probably too much money. How, if at all, have all these different funding sources affected the way the venture business works?
Let me just shut that one. Yeah, okay. So, the venture business basically is a relatively young industry. If you take a look, it's only like 40 years old. So, just like any industry, and especially in a free enterprise system like America, you will see these opportunities. So all the stuff that you're talking about, it basically just talks about, hey, there's still plenty of opportunities, and there are so many different ways to get a company funded, get a company started, get a company going. And so I think it just, because the shifts are occurring and the dynamics are changing, it just basically talks about a vibrant, thriving industry. That's what it is. And competition, free market, is at play.
You're right in the sense that it's undergoing tremendous amounts of change, but I think that's also indicative of the amount of compression that happened in the 2008, 2009 timeframe. And I think there was a significant amount of entrepreneurial spirit and entrepreneurial energy that was sort of sitting on the sidelines that jumped into the market in 2010, 2011, and certainly a significant amount of sort of investing dollars as well that didn't have a good home somewhere else that jumped into the venture capital industry. So there's good money, there's good talent. I think that's a really good combination. It's healthy for the industry. The industry is cyclical. I mean, like all financial industries, the venture capital is not. This is not, it's not a sort of steady business. It's a very, very cyclical business. So it tends to over-rotate quite often. So I wouldn't be surprised if there's a little bit of an over-rotation on too much optimism and too much money chasing too many people. That does happen. That's a very self-correcting mechanism. It's also, just like sales, venture capital is, and most financial industries are highly metrics-driven. They tend to correct themselves pretty quickly. So if there's an over-rotation, I think it can correct itself. But overall, it's good. It's a tremendously exciting time to be an entrepreneur because there's a lot more of a support system around. There's no longer, you don't have to go down to just like for VC firm talent sample and try and sell an idea, you can go to angels, super angels, micro VC firms, early stage VC firms, stage agnostic VC firms, late stage firms, PE firms, secondary markets, and then public markets. I mean, it's crazy how much opportunity there is for entrepreneurs. It's pretty exciting.
I think it's a huge opportunity for entrepreneurs. I mean, the venture capital business thrives on entrepreneurship, and nothing facilitates entrepreneurship more than the availability of capital. So by lowering the threshold, by making capital available at with very, very low levels of rigor in terms of diligence to get things off the ground, I think makes it a lot easier for entrepreneurs to go out there and feel more confident about quitting their jobs and going out and doing to achieve their dreams. We as a firm don't have as much involvement with this type of investing because there's not really a whole lot you can accomplish on small dollars when you're dealing with a novel technology. But when I see people around me that are getting funded and are getting their ideas off the ground, this is very promising.
What are you seeing internationally? We talked a little bit about India and China, but a lot of countries are expanding around the world. Lightspeed's got operations in both India and China, and I think probably all of you have been involved in that. So what can you tell us about things going on outside the U.S. that might not already be known?
I can start this one. So we've been international for a number of years. Our first international office was in the late 90s, and that was in Israel. And we've been in India and China for a number of years. The way we're seeing it pan out, these are very exciting markets, very large markets, but you need to give it the kind of focus that it needs. You can't be the quarterback venture capital guy sitting out in Silicon Valley and trying to project, okay, I think this is going to be successful in India or that's going to be successful in China. That just doesn't work. You got to have people on the ground who've got relationships on the ground, a good understanding of the market. And when that whole ecosystem gets to a point where it can sustain itself, we feel the best way to make returns for our investors is to really let them go and be independent, which is exactly what we did with our China fund. Between India and China, it's sort of interesting. I think there's a little bit more maturity on the entrepreneurial side, on the China side, from what we've seen, and that's very sort of microscopic view. I'm sure other analysts might have a different opinion, or maybe yourself as well. But we continue to invest in both countries pretty aggressively. European market is pretty interesting. It's been somewhat cyclical, but I'm hopeful, I'm bullish, and I think there's a lot of sort of entrepreneurial spirit there. And so a couple of things coming together in an interesting way. I think that Europe has historically been slightly more risk averse than the US. So here, here it's almost a good scar when you say, hey, I started something and it failed. We don't really hold that against people. And that wasn't really the case in Europe for a really long time, but I think that's coming around. There's a lot more dollars available there from non-venture capital entities too. There's some angels that are operating there locally. And the governments, both in Germany and France, are pretty supportive of sort of internal innovation. So they're making a lot of dollars available for innovation. So I'm hopeful. I think there's some good stuff that's going to come out of Europe as well.
There was a question right here.
I'm wondering if your investment horizon has changed. When do you expect an exit, and how large is the average company at exit?
So has the investment horizon changed, both the timing and the size of the company when it exits?
I can say for us it's been constant. We expect our fund lives are somewhere around, say, 7 to 12, 13 years, on average, say 10 years. And we'd like to see a company exit depending on what stage in our fund cycle we invest, exit in the next, we expect it to invest hopefully in the next 5, knowing it's going to take longer. And in terms of multiple, we're in this business to make 10 times, to expect to make 10 times our money on every single one of our investments. So if we're expecting a company to acquire, what was it, $80 million, then we have to be shooting for $1 billion exit. Otherwise, otherwise we're in the wrong business.
That answer applies pretty much word for word to Lightspeed as well. The majority of, especially my focus, the majority of our focus is on enterprise IT, much like what Shaheen focuses on. This is a long-term business, so our investment horizon is going to be constant. It takes 5 to 7 years to build a good enterprise business. We're patient investors, we've got deep pockets, we support our investors, we're early stage investors primarily, and we support our companies through all the round. We will lead We'll take board seats, we'll support them through subsequent rounds as well. So we're very patient investors. In enterprise, you have to.
Yes, question, right.
Pete,
Yes.
as you mentioned, even though you have a long-term horizon, the lack of the liquidity that the IPO market brings is having a substantial negative effect on your industry, on startups, and the general economy. It seems to me that would be a great opportunity for some smart guys like you to invest in an enterprise solution to help drive that IPO market and replace the four horsemen with a technological solution to make companies stock available for people that want to invest in high risk but on a public basis, especially in light of the fact that we have the Jobs Act that opens up some doors to opportunities that didn't exist before. Any comments about endeavors underway to try to open up that IPO environment?
Very simply, the question has to do with the lack of IPOs, the lack of liquidity, and its impact on the industry. And are any of the panelists doing or seeing investments that would help to create liquidity in any form, using technology to make it easier for companies to get liquid?
I mean, there is a second market that gives early shareholders an opportunity to sell their restricted shares on.
That's up and running, and that's certainly one way.
And that's been pretty successful, especially with Facebook being a huge driver behind it. As far as technology is concerned, to help accelerate, so for example, we're looking into the whole manufacturing automation space. So right now, there's a long turnaround time associated with having a new design for a product and getting it ready for manufacturing in Asia. And you may think a lot of that has to do with labor. It turns out that it's not the case because a lot of the manufacturing right now is automated. It's actually the engineering labor that goes into tooling up this new manufacturing line. And so we're looking at technologies both on the robotics side and on the software side that would accelerate that turnaround time. And to the comments that came up earlier in terms of enterprise solutions, to be able to shorten that time to market so a business can get into revenue faster and then potentially make it a more attractive candidate for an IPO financially faster. So that's a long-term solution, but it might work in the direction that you're alluding to.
I think that there was a couple of different questions in one, right? One was a comment more on liquidity events and the lack thereof, and the other one was, given that pain point, if you buy into that pain point, what are you doing about it? So I'll address the first one first. I think for good companies, there is no dearth of liquidity events even today, right? So think about it. Q2, if you look at the total, Q2, this past Q2 12, was the most successful quarter by dollars for venture-backed IPOs on US exchanges. The highest amount of dollars generated, right? Now, admittedly, there's, lies, damn lies, and statistics, because if you scratch that a little bit more, I think 90% of those dollars came from Facebook. Having said that, there have been a number of really, really successful IPOs this year. How they've done post-IPO notwithstanding. So there's liquidity in the market for companies that have generated, really true value. There's also the fact that historically corporates are sitting on just a tremendous stockpile of cash today. I think in the presentation Steve might have pointed out, the top 10 firms hold about $350 billion in cash today. So for good firms, and Shane and I were talking too, a couple of his investments got picked up by public firms too, and this happens all the time. One of our investments just past month or two ago in the software-defined networking space got picked up by VMware for over $1 billion. This happens. This stuff is happening every quarter, almost like clockwork. So for really good companies, even in a space like enterprise, there's no dearth of liquidity events. There is tremendous opportunity, although it does seem like things are getting a little bit tighter. In terms of sheer numbers, yeah, there are not as many IPOs as, say, 4 years ago, but they're certainly better than 2008, 2009, 2010. So the market's getting better. The second part of your question, which was, has our partnership, for instance, invested in this? I think it's an interesting space.
It's already working because the whole IPO on-ramp process where, some of the regulatory requirements were, eased, so some of the, how you communicate, how you kind of, go do a pre-market, a lot of stuff really kind of got changed. And I think that's already, because number of companies already are taking advantage of that in the IPO process, so that actually helping.
I'll give you a business idea right now. So I might be a little bit controversial on this. I really believe, things like the Job Act, things like the number of agents in the marketplace today, a lot of people are going to burn their fingers. Like, this is a very risky business. Entrepreneurship in general, and certainly investing in entrepreneurs, is not for the faint of heart. So I think a lot of people are going to get burned, once they really start dipping their toes into this market. So the opportunity is for businesses to help assess risk better, or provide services around, what are good investment opportunities and what are not, just like financial services do for the public marketplace today. So, there's Jobs Act does create liquidity. It's certainly good for entrepreneurs, and it's certainly going to create opportunities in this sort of ancillary marketplace where once people, they burn their fingers, they're going to be like, okay, wait, who can advise me really, really well in this space? So,
I'm not too sure what you're talking about. There are two sides of job site. One was just the IPO on-ramp. Which is really the main thing.
Right. That's what I'm most interested in.
Yeah, crowdfunding is afterthought, that's bogus.
That's
You know,
well,
that
that's
is-
what I'm talking
that-
about.
yeah, so
It
that,
might
yeah.
work, it might not work.
Crowdfunding, because when this act was presented to Congress, it's very interesting. I knew the guys who wrote the act, and Silicon Valley, one of the lawyers from Silicon Valley was involved. So they went, because the average congressman's comprehension level is great, I say it. So they came up with this term. Initially it was called IPO and National Venture Capital Association, and other people, they kind of led this effort. But to sell it, make it sellable, they came with the acronym, called JOBS. So these guys, they go and ask the congressman, well, we're trying to push for the JOBS Act. Oh, JOBS Act, I'm for it. I'm for jobs. So it's amazing if the Republicans led the initiative and the Democrats just totally fell kind of, right, in line. Most of them really didn't understand. But basically what happened that, we have very punitive regulatory burdens. To take company public, the whole Sarbanes-Oxley compliance that kind of was, knee-jerk reaction, became a law, and that really, when you spend $3-4 million just to do, the business was mainly for the accountants and other people that got in the business, and all that kind of stuff, just picture that, okay, so you're trying to take your company public, and you got all the other stuff, and then, the delays, and et cetera, et cetera. So the IPO on-ramp really actually boomed to this, the liquidity stuff, okay. So I think that's one that is really working. We get a number of companies that were backlogged, that were just kind of stuck in this pipeline. They are, I have many of my lawyer friends that are busy. They are really, really busy just trying to get this thing done. So I think that's a real plus.
It's working.
Oh, absolutely.
Oh, yeah,
Absolutely.
2013 I expect to be working.
Absolutely working.
It's going to be very
Really.
So I was thinking in terms of technology, like where, 10 years ago it was impossible to buy or sell a share of stock if you're a retail investor without calling up the guy called the broker. Now, very few people do that. And that to me is the opportunity, is to do for the IPO what electronic trading has done for existing public shares, and just supplant the middleman with the technology. I mean, that to me seems to be, when coupled with the Jobs Act and what that permits, that seems to be the opportunity. I'm in medical stuff, so I'm not opposing it. I'm just saying that I've been around a long time, and it just seems that there's an opportunity that no one seems to be latching on to. It seems to me.
Good question.
So I was going to ask, just in general, what do you see as the back pressure against IPO, and specifically is SOX the main thing you're seeing pushed back against? Because at least in the sector I'm in, internet, there's a lot more money flowing through the internet now than 10 years ago. There's still plenty of irrational exuberance about companies. Like, I'm sure the public would buy in if they had the opportunity. Like, that's my perspective. I see SOX.
No, I think-
What do you see?
Yeah, let me just, I think what's happening right now, and this is really a good thing. If you take a look at the companies that are going public, actually the last 2-3 years, all these companies, it's no longer what the exuberance was during our companies, okay? Because you basically had no business, you had no revenue, nothing, and you just selling hope and whatever, and a lot of money that kind of went into the market. Now, the companies that are going public, and you take a look at every company that is going public, these are legitimate businesses. These companies got revenue, they got profits, they got growth. So this is the way the business used to be. So what has happened right now, okay, that actually it is a lot more sane. It's no longer, all the companies that you take a look at, even the companies that are getting sold through M&A process, with few exceptions, are purely strategic, acquisitions. So like, you mentioned Nicera, right? That was a huge exit. VMware paid a lot of money for it. People have made money. But that is very strategic to them because they felt that that was very strategic to where they're headed. So even the M&As are really very well thought out M&A. They're not just, so I think the overall you see the business is, returning back to normal the way it should be, because if you're a business, you got to generate a profit. You got to, have growth. You got to have, you got to satisfy real need, real demand for consumers. People are talking about Facebook IPO. Yeah, sure, the IPO, maybe lost value, but if you take a look at Facebook, it's a legitimate business. 8-year-old company, and look at what they've done. The number of people who are, using Facebook, and they have legitimate revenue, they have legitimate stuff. Yeah, the stock kind of got overpriced or valued, but nonetheless, it is a very healthy business. So you take a look at all these companies. Look at LinkedIn. Look at some of the other companies that have gone public, or companies that have, got sold. It's real business. So you don't have that stuff anymore. That you can just do something and people are just going to go and pay. Just a silly amount of.
But has it settled out, like if we looked at mid-90s ratios of M&A versus IPO, is it back to a norm, or is it, like, my perception is there's a lot of back pressure against IPO, mainly because that's the sort of things you read when you read about VC. Is it back pressure and it's unnaturally displaced, or is it at a healthy balance now relative to, whatever?
I would say it's healthy balance.
Yeah, I think just answer your own question, right? It's back pressure relative to what? So it's healthy now, and it seems like back pressure compared to an environment where no profit. I can't add anything new to that.
99 was nuts, right?
That was unhealthy.
Yeah.
This is healthy. This is good. We're healthy companies generating cash. This is good.
Time spans there. And you described the investment in bioscience as being cyclical, but frankly, it looked like it was having a pretty severe downturn. Is there something happening here that money is exiting bioscience just at the time when the FDA is, dysfunctional and we need more, not less money somehow? And if not your firms, are there any other firms that are helping lower the hurdle for actual returns in bioscience?
So I can comment on that. So we've done 4 therapeutics investments in the past 6 years, very early stage. Pretty much all 4 of them were almost inception stage when we got in. And yes, it takes a very long time. Yes, it's extremely expensive. But to answer your question, the approach that we took was to take a multi-pronged approach for every company. We only invested in companies that had a platform that could lead to multiple therapeutic targets. And we had the opportunity to license off or partner off those non-core targets to bring in cash and to help de-risk that core target that would have been the basis for an IPO or an M&A event. So, being creative as to how you can bring cash into the company, non-venture cash into the company, non-dilutive money, to shepherd that asset forward through the clinic is one of the approaches that we've taken. Now that we're investing from the third fund, our focus is more on later stage assets in the clinic on the therapeutic side, and we're shifting a lot of our emphasis more towards healthcare IT. So analytics, services for pharmaceutical companies, providers, payers. So being cognizant of the fact that things take a long time and are very expensive, we've kind of broadened our approach to healthcare as well.
Thank you.
We're not investors in the biosciences. My only comment to add would be, much like good entrepreneurs are successful through extreme focus, the same rule applies to venture capital as well. So my sense is as the venture capital industry grows, you're going to find more and more focus. We focus, exclusively, part of our partnership focuses exclusively on enterprise IT, for instance. So more of the healthcare investment dollars are going to flow through funds that focus exclusively on healthcare and have the kind of expertise and strategic bent of mind that Shani just spoke about, right? If I go and try and invest in healthcare, I'd probably end up losing all the money because I have no contextual knowledge and I can't add much value. So I think there's going to be some specialization. Healthcare seems like a field that there is some renewed interest in the field. So, we'll see. I'm more on the sidelines than anything else.
I think another reason you'll have more specialization is particularly in an era like this, where the returns to life science for the past 3 to 5 years have been pretty poor, and IT have been more robust. And particularly the huge wins have almost exclusively been on the IT side, as by some of the ones we mentioned. So in a fund that does both IT and life science, very, very difficult for the life science partners to get any projects funded, because all the IT partners stand around and go, is this really going to be the next Facebook or Instagram or LinkedIn? Has there been ever one life science deal that good? So, you may like it, but I think we can take that money and invest in IT and do a lot better. And that conversation is going on in a lot of the funds that do both, and it's becoming very, very difficult to get life science deals through the park, or clean tech. Clean tech is being tarred with the same brush. Government. It wasn't that long ago that VCs didn't think about Washington, didn't go to Washington, took pride in the fact they didn't know where Washington was, and thought it was just a state up north. And I'm from Washington, so I know about all those jokes. Now, especially in life sciences, especially in clean tech, but even in IT, government's been more involved. We've got a very activist administration that may be in place for another 4 years. How does the government affect how you do venture, and in the next year or so, what things do you suspect government might do that would affect you, good or bad?
We hired former director of the CIA under Bill Clinton, Jim Woolsey, for just partially being the reason. He's a huge proponent of getting us off of Middle East oil. We understand that a lot of the cash that energy companies need should come from the government, because they have a lot to gain from these technologies being brought to bear. And we're totally cognizant of the fact that government plays a huge role in a lot of the successes of these kinds of companies that require a lot of cash and are very.
No, I got nothing new to add. I mean, you're right. I think, Steve, what you mentioned is more of a statement of fact than anything else. Vish might have some additional color on this, but frankly, we direct most of our efforts in terms of interacting with government through the NVCA, and I think that's healthy for the industry to present a certain sort of one voice, which is more likely to be heard than anything else.
Yeah, government, just like, any society, no matter what society you live in, okay, unfortunately, the government, is always there for you. And so, the good thing I'll tell you, regardless of what we're talking about American government and whether, the current policies are not very friendly to business and whatever, and, trying to, every day, millionaires are bad people and Wall Street guys are, crazy people. If that doesn't, the average person who doesn't really understand, okay, those sentiments are not really good. However, if you take a look at, and other governments are the worse than the U.S. when it comes to that, because those who are investing in other countries, okay, you cannot live without the government, okay? So whether it's Israel, whether it's China, whether it's India, the government is so much, in your stuff, even the employment laws, the labor laws, the tax.
Although in Libya, you can't live with the government.
Yeah, there you go. Yeah, you can, yeah. But I think one thing that we should also, those of you who are entrepreneurs or even businesses, government is a big consumer of products. Government buys a lot of technologies. So, federal governments, state governments, city governments, go look at just the IT budgets. And a lot of Silicon Valley companies, they all do business with the government. So the government is a consumer of whatever entrepreneurs actually produce. So, government is always there. Those who are entrepreneurs, okay, my advice is don't start a business and start with the government as your first customer, because you will definitely not go anywhere. Because, the amount of reporting and the disclosure and all that kind of stuff, and you got a 10, 20, 30 people company, you will die just to give them. So don't even go that way. First, make it commercial success, and then you try to see if you can sell to the government. But, with the government, definitely, easing regulations. Okay, I commend our, government right now, passing Jobs Act. Like that has been a very healthy stuff. Even though it has a 5-year, the emerging growth companies, and 5 years, They kind of gave it, basically what they've done is they've temporarily suspended some of these regulatory stuff, and so that the process could be kind of accelerated and companies could thrive. And all the other, you saw, last year Congress passed the act of the Small Business Act and stuff like that. So these are basically just trying to give them some incentives. And at the city and the states level, the tax, is always a problem. So, but as you said, okay, Washington D.C. is not the highest because all these high-powered lobbyists and lawyers, they all have food over there because why are they there? Because there's a business, there's money to be made. So that's why the guys going, Silicon Valley's income used to be the highest in the country per capita. And Washington D.C. just took that, status away about 6 months ago, right? Something like that. But, you have to, you have to work with your government, but, most entrepreneurs, starting out, you really don't have to think about the government or don't rely on them, don't depend on them. Pay your taxes, don't break laws, just, continue on and, no need to get bothered with all that because you're not going to fix those problems.
There's probably a number of people in the room here that are either in the process or will be trying to raise money in the next handful of months. You all have seen hundreds of pitches, and what are some of the lessons that we can convey to the audience about either common mistakes you see otherwise smart people making, or best practices of how to raise money that might make the money process more efficient and more successful?
So I can take a shot at that. Two basic things. Number one, strength of your business plan. And be able to tell me your story in 10 minutes. Very simply. What is the pressing problem you want to address in the marketplace? Who else is trying to solve the problem? What is your approach? Why do you think your approach is so superior? What does it take to build a business in terms of talent, in terms of other resources? And what does it bring in? Revenue and profits. And tell me that story in 10 minutes. If you don't have an answer to that, say, I don't know that, this is where I need help, rather than saying, well, just give me the money and all my problems will go away. The reality is the day the money comes in, all the 100 problems that you ignored, they all come start staying in your face and your business goes nowhere. So that is the thing that I look for.
I'll make that answer, if you don't mind, Bishop, a little bit more nuanced, because it really depends on the entrepreneur that's walking in, from our perspective, as to what stage you're at, right? We're early stage investors, so we've got a very wide range of entrepreneurs. There's the super smart engineer who's not quite sure how to productize a particular technology, that could be walking in the door. And in which case, there's no business plan, there's no sense for what critical problem you're trying to solve, but you've spent years and years and years thinking about a particular technology and you feel like it's going to disrupt some big market somewhere. And that's okay. It's okay. It's okay to walk into Lightspeed doors and say, I've got a fantastic technology. What do I do with it? And and most VC firms are now much more service oriented. Even they've always been to some extent, but even more so than the past. There's EIR programs. There's certainly a lot of counseling and guidance that the venture capital firms themselves will provide on how to ship it, polish up the idea and sort of ship you towards profit. So that's sort of at the early stage. But if you're coming in for an A or a B, then by that time, roughly speaking, let's think about this. Roughly speaking, when you're about to raise a seed, it's okay to come in with a really good sort of an idea for this is the rough market I want to go after, and here's what I bring to the table, and we'll help you craft it out. This is how I'm going to get it to the market. If you're coming for a B, you better have a few customers behind you. And these are generalizations, so it's certain deviations, but you're coming for a B, there better be some customers behind you who say, yeah, we believe in this technology, we bought it. And so on and so forth. So at every stage, there's it's a very nuanced answer. Like don't necessarily just Google raising venture capital and go to the first blog that says if you don't get the VC's attention in the first 2 minutes, everything's lost. Don't try and do that. Don't put yourself through so much punishment. We have tremendous amounts of respect for entrepreneurs. Their job is on any given day 1,000 times tougher than ours. Right? So we're patient people. We will help you, at an early stage, craft the idea a little bit more. But at the same time, if you're, if you want to raise $5 million and you can get
But
for a B or B.
you gotta be practical. I know this is Vice Chancellor.
Yeah.
The reality is, that's the truth. You, me, anybody, all the 300 VCs and okay. You see companies all the time. You see, we're talking about how many we receive versus how many we fund. So it's not a question that, the reality really is because, and that's where, because no one just walks into a Lightspeed door or my door or your door, you gotta come to a referral.
Right.
Because that is the number one stuff, okay? You have to be smart about it, you gotta go to referral. If you don't know who to get hold of Lightspeed, look at Lightspeed's website and look at the portfolio company they're funded. You'll be surprised, you can call one of their portfolio company CEOs who is an entrepreneur. You say, I'm so-and-so and I have a kind of company in your space and, I was thinking Lightspeed, could you give me 5 minutes? That your company, portfolio company CEO is more apt to give the entrepreneur a time because he relates to that person better.
Yeah.
And then your entrepreneur can say, well, dear, thank you very much. Can I use your name when I call Guru? And believe me, when you get the email, introduce a referral line,
I'm taking the call.
you take the call.
No,
So
that's
the
very
reality
practical
is because the
suggestion.
practical thing in this business is because you take a look at thousands of people looking for funding every day. Angel, seed, Series A, B, C, D, whatever you talk about. So you have to, because how do you get attention? And we're talking about, and one thing is that, those of us who are in the business for a long time, is very quickly we can assess, because it's not that you really have to, I can maybe, I've been around for quite a while, I can tell, okay, if the entrepreneur is really bright, has something, I can figure out as well. I think I got something that I kind of want to work with the person, they want to kind of pursue further. But most people who just, every day they're going and trying to, if you got time, let's say you got secure time with Guru for half an hour, 10 minutes, if Guru is not convinced, because he had decided, should I follow up with you guys, after that, he has made up his mind. Being polite, he's listening to all that kind of stuff, nuance, we are friends with entrepreneurs, all the VC, all websites are the same, okay? So I'm, being a VC, but I'm giving a practical guide to entrepreneurs. Everybody, English language is not very rich. So the way you describe, what a VC does, is pretty standard, okay, everybody does. So you have to kind of go beyond that. And so in terms of practical advice, that's what you have to do. You should be able to tell the story. I know this one, I have no idea about that one. I have no idea how to market it. All I know, I'm just a technologist, maybe the VC who is smart, I've seen this many times, but this is really unique, and this, tell me more, right? Or come back and see me. So I think that's what I just wanted to just because
No, that's a good point, and I agree with that.
Constantly we see people every day, and then they get disappointed. The other thing also to say is, which is message to entrepreneurs is, it's not between you and the VC. Let's say you have a Guru and you spend 1 hour with him, and it's not that you have to call him and harass him every day. So, what do you think? And I got one more this or one more that. You are competing with all the other individual entrepreneurs who are reaching out to him, or me, or all the other guys. And I tell the entrepreneurs, I said, because at the end of the day, we are looking for, it's like your job is write checks anyway, because that's what we do for a living, we just write checks. The question is he going to get my check, or she, or him, or whatever? So it is a competition that is coming to us is among the entrepreneurs themselves, not between the VC entrepreneurs. And this is one thing that I see all the time. And entrepreneurs, they will just sometimes they just get pretty, what's wrong with me and blah blah blah. That's not the idea. You got to tell them it's a free market. It's a competition. You have to earn it.
Agreed, and I think that one piece of advice that I have for entrepreneurs is to not discount the importance of being able to properly define the problem that exists, or be able to quantify what your customers or their customers are willing to spend to solve that problem, the deep pockets that are out there looking to solve this problem, and how unique your solution is. You may think that VCs don't want to be educated, but the reality is that VCs want to hear you pitch the problem and be able to go up to other investors and help them grasp the problem and be able to really, really have the problem resonate with them. Because the solution to the problem, it might be kind of counterintuitive, because a lot of entrepreneurs have created a solution. They're engineers, or they're managers of engineers, and they think the core of their business is their solution, whereas the reality is that what we are banking on is their understanding of the problem, their ability to navigate the business, their ability to get to the dollars that are needed to solve the problem, and to be able to create enterprise value at the company. And the solution of the technology is simply just a tool. Of course, you have to be able to communicate that very well, but unfortunately you see a lot of entrepreneurs emphasizing the solution over the problem. And that makes life difficult for us as investors, because we have to be able to communicate this with our investment committees. And we don't want to be doing that for the entrepreneurs.
Well, thanks. Now that you have all the tips of how to get money from these guys, they still have big wallets left, and they're going to be here for a few more minutes after the event. And there's more food and drink in the back. So I want to thank you all for coming. I want to thank our panelists, and I look forward to seeing you next quarter.